have a 3-3-3 tie, but we've never had that, I think. But I was also conscious that we're setting precedent here, and in this case, I personally was in the 5 that were preferring a cut, but let's say I'd been in the other side. Let's say I'd been one of the people preferring to hold. Had I used the casting vote, I would then have had a bit of a dilemma, because I could have used it to back up my own original vote, but then the outcome would have not necessarily really reflected the balance of the distribution of votes. Or I could have used it to achieve that, in which case I would have ended up voting both ways in the 2 votes. And so I think it was a better outcome and a clearer outcome to say, let's have a second vote.
Sounds like a sort of logic problem, doesn't it? But that's partly.
That was how we got
okay,
there.
I just wanted to get that procedural point out of the way, and I obviously want to come to members about their own decisions. But before we do that, there's obviously been big things happening across the Atlantic with attacks on the Federal Reserve's independence. Yeah. As the head of the Independent Bank of England, I wondered if you had any thoughts or comments to make about the impact of that, both on the global economy.
This is a very serious situation. I am very concerned because the Federal Reserve is obviously, the central bank for the world's largest economy. It's leading central bank. It has built up a very strong reputation for independence and for its decision making. So this is very concerning. And let me just make a comment on why it's concerning for me, the underpinning point, because this applies to all central banks, I think. Monetary stability and financial stability, which are our 2 objectives, underpin, I think, sort of the foundations of policy. One way of putting it is that if we do those things, we enable you then to go off and take decisions, in the areas that appropriately, governments and Parliament should take decisions in, which involve things like sort of distribution issues, knowing that the foundations are sort of sound. And I think that's important. It was very strongly the view I know of the government when the bank was made independent, certainly in respect of monetary policy. And I think what we're now seeing is people saying, well, no, actually, we should be able to trade off the sort of the foundations for those other decisions, if you like. And I'm afraid I just think that is a very dangerous road to go down. I think the job of an independent central bank is to provide those foundations, to take independent decisions to do it within the remits we're given by you. With sessions like this, we're accountable to you. That's how it works. That's how it should work. And so the threats to that, I take very seriously.
Okay. And have you had any conversations with your counterpart in the US?
Yes. I mean, we talk regularly. I was at the Jackson Hole conference 2 weeks ago. I'll be seeing him in Basel this weekend. So no, we talk regularly, as we do normally. I mean, we always talk regularly.
Okay. Mr. John Gray, MP.
Just to kind of explain this thing about the independence of central banks to a way that my constituents would immediately grasp, would your position be that be careful what you wish for, because if you lose the independence of central banks, ultimately you will face higher prices,
yes,
higher mortgages, and higher costs of borrowing for social housing and business? Is that in simple terms?
Yes.
Thank you.
Thank you. There are costs to it, yes.
As ever, we want to drill it back to the impact on our constituents. So, to the decision. So we've got Megan Green and Claire Lombardelli, who both of you voted to hold interest rates and not to cut. So I thought I'd come to you first, just if you want to explain why you took that position. If I start with Megan Green.
Sure, thanks. As you point out, I voted to hold bank rate in August, and this was motivated by 2 main things. One is I think the risk of higher inflation persistence has increased. And secondly, I think the risk of weaker demand has decreased, particularly since May, when we first put out and really fleshed out these scenarios. On higher inflation persistence, household and business inflation expectations have been elevated for some time now. The bank's done a bunch of research showing that actually sensitivity to inflation increases at a lower threshold than it might have previously, because we've just come through a period of high inflation. So that threshold's now around 3 to 4%. We now have our inflation forecast topping out at 4%, so at the very top of that band. Much of the news that we've seen in inflation and feeding through into our inflation forecast has been in food prices, and food prices alongside energy prices tend to be highly salient for inflation expectation setting. And so there is a risk that you could get higher household inflation expectations, which could feed through into the wage setting process. There's also a risk that you could get higher business inflation expectations feeding through into the price setting process. The decision makers panel shows that firms are much more sensitive to upside surprises inflation now than they had been a few years ago. So there's some risk there. So I think the risk of higher inflation persistence is higher. We've also seen core inflation has flattened out for the past year. Higher frequency measures of underlying services inflation have flattened out for the past year. We expect services inflation to stay at 5% through this year. So there are some signs that maybe the disinflationary process is slowing down. We've also seen that a lot of the adjustment has come from sectors that are more interest rate sensitive. So that could indicate that some of the low-hanging fruit has already been picked and the last mile might be a bit tougher. On the demand side of things, we've looked at the relationship between the labor market and activity, and it's remained intact. We expect GDP growth to pick up, underlying GDP growth particularly to pick up modestly from here. So that suggests that any kind of labor market shakeout that I had been worried about before probably won't be coming. Employment intentions are still negative, but they're less negative than they had been previously, and that's from our agents. That suggests that some of the, or much of the adjustment in the labor market may have already occurred. And in May, I had actually been much more worried about trade policy uncertainty and the disinflationary implications of that on the UK economy. We have a bit less uncertainty now, so that has abated as well. So I'm more worried about higher inflation persistence, less worried about lower demand than I had been, and so I saw it appropriate to vote to hold bank rate.
Okay, thank you, Ms. Green. Claire Lombardelli.
Sure, thanks. As you say, like Meg and I voted to maintain rates at 4.25%. Similarly, because of my view of the balance of risks to inflation as we see them now, I'll try not to be too repetitive on what you've already heard, but I think let me talk a bit about inflation persistence and I'll talk a bit about activity. On inflation persistence, I mean, look, inflation is currently at 3.8%. It was 3.6 when we voted. That's obviously too high, and I would draw out a couple of similar things to Megan. There's a question about both the headline path and about the composition. So on the path, we've now had inflation quite high for people, for costs for businesses now for a number of years, since 2021, apart from a brief period last year. It's been well above target. I think that length of time has an effect, as well as the threshold effect Megan talked about in terms of perceptions and experience. There's the other thing I would draw out is this point about the composition, which I do think matters. In particular, we've been surprised by food price inflation. It is higher than we expected it to be. We expect it to continue to rise, and actually on central estimates we have it going up to about 5.5% at the end of the year. That's obviously worrying in and of itself. Food is a necessary good. This is extremely difficult for people. It also, we know, has this salience issue. People notice it more than other price rises, and so we're very conscious that people will be sort of alert to that. It's one of the reasons why we spend quite a lot of time thinking about food inflation, why we spend a lot of time talking to supermarkets and others about what they expect. So I think there's that. Now, you have to balance that against the risk that underlying disinflation is continuing, has certainly over the last year. There is an open question for me when you look at the data about whether that is slowing at this point or not, and I think there's sort of risks there. If I turn to activity, and we spend a lot of time looking at sort of underlying activity rather than the kind of more volatile month-to-month data, but it's very clear activity is sluggish in the UK economy. That's obviously a problem for prosperity and well-being. It's also a problem for inflation. And the thing that matters when you think about inflation is what is driving that and the balance between demand and supply. And Megan's talked about some of the factors, particularly around demand, and we have to be very alive to the risks of demand deteriorating. And then I think there's a particular risk about the consumption savings mix, and maybe we'll come on to talk to that. But the other thing that I think is really important here is low activity isn't necessarily an issue of demand. It could be an issue around supply, and I think there is quite a strong case to worry about supply in the UK. We know there is this long-term challenge on productivity. You know, we've seen that over a number of years. There's also evidence that the labour market is structurally changing, and that may be having an impact on supply. You know, issues around population, demography, health issues, all of that we're sort of aware of happening, retirement. We also have a long-standing issue about private sector investment in the UK, and of course that affects supply capacity. I sort of make this point because actually if you've got a more activity more constrained by supply than demand, then obviously that's putting more pressures on resources, and that has a different impact on inflation. So I think it's slightly more complicated than just saying because you've got low activity you must necessarily have a problem around demand. I think we have to think quite carefully about the balance between the two. So sort of taking all that together, I judge that maintaining a slightly higher level of restriction would put more downward pressure on inflation.
Because it's interesting, I'll come to the Governor in a moment, because Governor, you've talked about the risk that disinflation momentum could slow as well. But before I do that, I think because Professor Taylor, you voted for a 50 basis points cut, and so therefore you ended up shifting your vote. So can you explain the rationale and why you voted the way you did in the end?
Yes, I voted to cut by 50 basis points. And I think this is in the context of a view that, formed in the last 6 months since I was last here speaking to you. I think in the first part of the year, there was a lack of clarity both in the data and because of the uncertainty in the international situation, knowing that tariffs were coming. And there was the arrival of the predicted hump in inflation, which is now unfolding as we expected in our February forecast. So at that time, I felt like I needed to wait and see and have more clarity on what tariffs were going to do and whether the labour market would continue cooling, whether wage inflation would continue to come down. And I think that became clearer as we got into May and June, particularly as we started to receive data on wage settlements. And I still think what we said a year ago or more about the crucial role of wage inflation in feeding into services inflation was the key thing for this last mile of convergence to sustainable levels of inflation at target. So I think it's about balance of risks, which have already been mentioned. It's just that I see the balance as being in the other direction than my colleagues. I'm cognizant of expectations needing to be taken into consideration. And it's true that household inflation expectations are somewhat elevated, though not dramatically relative to their historical mean and standard deviation. On the other hand, financial market inflation expectations are more benign and have actually been coming down more recently, and firm inflation expectations are in the middle. And exactly what signal-to-noise ratio those different types of inflation expectations have it is important to take into consideration. So I think on that we need to watch inflation expectations, but that for me they're not flashing red yet. Whereas if that's the main concern on the upside, I think for me on the downside it's more a constellation of risks where multiple things could crystallize, both domestically and internationally, and that I think are all in play. So I think wage inflation is coming down. We're seeing readings for this year which are in line with our agents' prediction in their survey in January. They were predicting a number like 3.7. I think the current average in the settlements database is 3.6 for calendar year 2025. And as I think I mentioned in my previous testimony, as you go through the year, as we went through last year, those wage settlements tended to be slowing down depending as you went from January through to December. As you went through each successive month, the later settlements were coming in lower than the earlier settlements. And I speculated when I last appeared that that pattern might repeat this year, and that is what we're starting to see as we're starting to see settlements coming into the data set for the latter half of this year, and particularly in the final quarter. We're starting to see settlements around 3, 2, or even lower. And that's confirmed through more anecdotal evidence when I go out with the agents and talk to businesses. I say, what are you thinking of doing next year for your wage settlement? And I'll ask the agents, what have you been hearing about what they think will come next? And it's generally coming in the low 3s or thereabouts, and possibly lower, suggesting to me that we are completing that last mile of that trajectory. So the concern about inflation expectations has to be weighed against the actual incoming data on wages, because I think the most risky channel for the transmission of inflation expectations back into inflation, actual inflation, is through wage bargaining. But I think given the softening in the labour market, and we can come on to unemployment and the slack in the economy in due course, that risk of inflation's feeding through wage bargaining is abating as the labour market softens. I'll come into the other risks in the constellation there, but I wanted to emphasize the wage issue as the most important. I think the hump is a difficulty. I knew kind of in May and June, I looked at the hump and I said, Alan, when are you going to kind of, maybe look a bit out of line? Well, it's going to be when the hump reaches its peak, which is around now. So I have faith in the underlying disinflation process, but we've got a disturbance now, which I don't think is a manifestation of persistence from last year or 2 years ago. It was a new set of shocks that we got in January, administered prices, taxes, a little bit of an energy shock, and now some food shocks. So I think I'm trying to see through that, but this is the hardest time to do that. I think the tariff situation, we're now at the highest tariffs in the post-war period, or since the 1930s, in terms of what's happened with the new US policies. That's only just starting to manifest, I think, in what we're seeing in US data, and I think it's only going to trickle through in the next year or two into the rest of the world as trading patterns rearrange. So I'm expecting, we're seeing it in some sectors, maybe autos, a lot of cheaper goods that couldn't make it into the US market will start to wash up on our shores, on European shores, and therefore affecting us through intermediate products in their market that then filter into our prices. So I think a lot of that is coming and will be loading into the 2026 economic conditions that we face. So all of those worries are in the back of my mind. I think the tariff issue is a little bit undercooked in our baseline forecast, so there's a point of disagreement for me there. There's also a point of disagreement in terms of the current output gap or the slack in the economy, which I think is a little bit worse than our current model is suggesting, because we're putting a lot of weight on the nominal block, whereas I think the rest of the signals are saying the economy is a little bit weaker. And then, of course, lastly, I tend to think the neutral rate of interest is quite low, and so I feel we have further to go to reach neutral, which leads me to think, therefore, currently we're more restrictive, and that we're plenty restrictive enough to take the remaining underlying inflation out of the economy, and I think we're seeing that in the way the wages are developing. So overall, I'm more in the 4+1 camp in terms of how many cuts per year, maybe 4 or 5, rather than 4 minus 4 or 3. And so I think that led me to my vote.
Okay, that's very comprehensive. Thank you very much. And Governor, we've talked before here about that gentle trajectory towards the 2% target, a cut of 25 basis points. What was the reason for your decision?
So look, I mean, I won't repeat everything obviously being said. I'll sort of just position myself, if you don't mind, around the colleagues. So I agree with Megan and Claire that I think, well, Alan said it as well, that we have got, the risk on inflation has gone up. I think where I differ a bit is that I think I'm more concerned about the downside risk on the labour market. I think there is more evidence of some weakness in the labour market coming through. The pay number came in under where we thought it would be based on the May forecast. So I put a bit more emphasis on that downside risk. That's context. Policy, I do think, remains restrictive. That's important. It needs to. So the question then is, as Alan was saying, is how to then judge the hump. I think the causes of the hump are mainly not telling us about the underlying state of the economy, but it is inflation nonetheless. I mean, we can't get away from that. So the question is it going to create persistence risk? Well, I think context does matter here, and this is where my concern about the potential weakening of the labour market is relevant. So for me, I think the judgment was this: I thought it was appropriate given that downside risk that we did a further 25 basis points, but I also thought it was appropriate that we gave a message which focused on this inflation risk. And what that really turns into is a judgment that although we've taken a further step, and although I think that the path will continue to be downwards gradually over time because policy is still restrictive, there is now considerably more doubt about exactly when and how quickly we can make those further steps. That's the message I wanted to get across. Now, I think actually, judging by what's happened certainly to market pricing since then, I think that message has landed.
Okay, well, thank you all for your comprehensive answers. Always helpful to have flesh out the official minutes. Chris Coughlin, MP.
Thank you, Chair. From what you've all been saying, if I'm reading correctly, I'd say, with the exception of Professor Taylor, it appears that growth and inflation risks have decoupled, perhaps. So I'd be curious about your views of, is the UK stuck in stagflation?
Well, I'd be happy to start on that. I mean, stagflation is not a word I tend to use because I think it's not a word that is, has a very clear meaning. So let's take the two parts to it, inflation and growth. We've all talked about the inflation hump, so that's, in a sense, I'm not going to repeat that. There is obviously an upturn in inflation. By the way, the hump is about 0.3% of a percentage point higher than we thought it would be, both in May and in February, actually. So that's the sort of dimension of it. On the growth side, I think come back to what Claire was saying. Claire made a really important point that the risk here is actually on the supply side. It's on potential growth. It's not so much on the demand. And the way of kind of really putting a sort of sense around that is that we think that the potential growth rate of the economy is currently around about 1.5%, and has been, by the way, for some. This is a description of most of the time since the financial crisis. Hasn't quite been that level, but that's a broad description of it. Prior to that, it was about 2.5%. So that 1% reduction in the potential growth rate is significant, and it's significant not just for monetary policy, but frankly, it's significant for other areas of policy. It's very important, and as Claire said, you can trace this back to both productivity, which has been weak, and has been weak really since that point about 15 years ago, and the other contribution to potential growth, which is the growth of the labour force over time. The question of the increase in the average age of the population is very significant, and it's a point I talked about at Jackson Hole. This, I think we all know it's happening, but I don't think it really features enough in the sort of the discussion of the issues around policy. It is very significant. Now, as long as we have those two sort of, if you like, sort of things restricting the potential growth rate, then we have got this tension. I think the tension runs through policy. And so I would say, again, it's very important, as Claire said, that, and it's not really for us then, but these supply side issues are the focus really of attention in policy making more broadly.
Does anyone else have any views on the stagflation point?
I mean, the only thing I would add is we're not in stagflation, and actually it links to the original answer that Andrew, the governor, gave in response to the independence question. Our target is 2%, and we will get inflation sustainably back to 2%, and we'll take the action needed to do that. And as discussed, we do have growth, 1.5%. So that is growth. It is not as strong as we would all like it to be, but we are seeing growth, and we are taking action to bring inflation down.
But of course, financial market expectations of inflation are consistently higher than the expectations of the bank. Does that ultimately undermine the credibility of the MPC?
Financial market expectations for inflation are well anchored, actually, around our target, and that is an important thing, and it comes again to this point about credibility, which is a key part of our the structure that we have in the UK. So, actually we are seeing those expectations anchored. When we look at inflation expectations, what we are seeing is we have seen on the short-term expectations of households, to a lesser extent businesses, we're seeing some movement there, but as Professor Taylor said, they're quite small by historical standards, but of course, because they're so important to the inflation formation process, we look at them really, really carefully.
I just add on a very basic level, if you look at our forecast, we have growth and underlying growth picking up from next year through the forecast period, and inflation coming down towards our targets, so that we're not forecasting stagflation.
Sure. And there's been a lot of concern in the news at the moment about high bond yields. I'd be curious to know your views on why you think that the UK currently has higher bond yields than France, even though France's debt to GDP ratio is higher, and actually the French government is at risk of collapse.
Well, we've got quite a substantially higher short-term interest rate than France, because France obviously is anchored by the ECB's rate, which is 2% currently. So that's an important point. Having said that, I mean, you've seen a steepening of yield curves across the whole developed world, really. So I do think two points I'll make on this. First of all, the underlying driver of this is global. Indeed, when you look at UK yields in terms of the steepening, we're actually about in the middle of the pack. So Germany and Japan have gone up considerably more than us. US less than us. We're in the middle in that sense. I think France has steepened quite a bit more. They've got their own obviously well-known issues. That's the first point I'll make. Now, on that point, going back to my previous answer to the earlier the previous question you asked, of course, that does bring these supply side issues into sort of sharp relief. This question about the potential growth rate, particularly in the context of fiscal policy. The second point I'll make is that I do think it's important not to over-focus on the 30-year bond rate. Of course, it's a number that gets quoted a lot. It's quite a high number. It is actually not a number that is being used for funding, at all at the moment, actually. Historically, the UK has, because it was a very sensible policy, which Claire was actually heavily involved in doing, of course, to lengthen the maturity of the UK debt stock. And there's real benefits of doing that. It was possible to do that while structurally, particularly the defined benefit pension world, these schemes were sort of still growing and they were demanding those sorts of assets. They're mostly now mature schemes, and this comes back to the aging of the population, actually. Yeah. So the structural demand for long-dated, long maturity bonds has gone down. And I think sensibly the Debt Management Office has actually shortened the profile of their issuance to reflect that. So there's a danger that we get sort of slightly overly focused on long years, because just to end with one fact, I think when you look, I'm not, Debt Management Office, the experts on this, I think when you look at the cost of debt issuance in the course of this year, overall, the average cost of debt issuance is at least flat and possibly slightly down. And that's because if you look at the 5-year rate, which is much more tied to our decisions, it's actually gone down. So there's a lot of rather sort of, dramatic commentary on this going on. I wouldn't exaggerate the 30-year bond rate.
Okay. Thank you. Bobby Dean, MP.
Thank you. I think I'll actually start with a preliminary question if I can, because Professor Taylor, you mentioned about where you think the neutral rate is and you're at the low end. And I just wondered if each of you could give me a sense whether you have a number in your head about what the neutral rate is, or whether you judge that as it goes, and if there is kind of any discrepancy between you as a panel, really. Could I start from right to left? So Megan Green first.
Yeah, sure. So trying to pinpoint where our star is a losing game. It's impossible to observe. It's impossible to measure that specifically. So, we've put out a few boxes in monetary policy reports providing ranges. I think the important thing to note is that there are a lot of reasons to think that the neutral rate may have gone up over the past number of years. So I think it's higher than it was. I could give you a number, but it wouldn't mean much more than anybody else's number, which is to say not a huge amount. I do think, though, that rather than coming up with a specific number for R star and trying to judge how restrictive you are on that basis, there are other ways to measure how restrictive monetary policy might be. And one way is looking at the monetary transmission mechanism, how much of policy has come through, how much is still to come through, and observing how much monetary policy is bearing on the real economy. And I think there are indications that we're still restrictive, but I'm not convinced that we're meaningfully restrictive. We've been in a rate cutting cycle for a year now, so it can't go on forever with us also being restrictive, and I think we're getting closer, which is an obvious statement in many ways because bank rate is coming down. But
well, I think I can confidently predict as you go down the line, you'll probably realise there are differences, quite important sort of philosophical differences of view on this question as to whether we know what R star is. I'm actually pretty close to where Megan has just described, so I won't repeat everything she said. I really agree with Megan that I use far more the approach of saying how restrictive are we judging by the monetary transmission mechanism. I think we're probably a bit more restrictive than Megan thinks we are. One of the and just to draw out one point there, the mortgage market is obviously a very important part of that story, and because of course we've switched to having a mortgage market which has gone from a variable rate to sort of 5 to 7 year fixed rates, it means that the transmission mechanism takes longer. So this sort of question about how restrictive we are does adjust over time. I think we said in the box, we're probably past peak restriction now. That's not surprising because we've been cutting rates, but because of the lag, it takes longer to get to that peak point. So I think we're past peak restriction. Probably, though, my difference with Megan is I think we're a bit more restrictive than Megan thinks we are, but we're basically in the same sort of philosophical camp, I think.
Sure. I mean, actually, I'm in a very similar position to Megan, I would say, which is, I think, and on this philosophical point, I mean, like the Governor and Megan have said, I mean, I think you can look at this in two ways. You can do the sort of model-based analysis, and you can do the sort of what does the data and sort of as you think about the analysis of what we're actually seeing in the economy, what do those things tell you together? We do both to try and understand this and to try and get as much information as we can. I tend to put more weight on the evidence of what is happening in the economy, and personally I think it is basically impossible to know sort of what the neutral rate is, certainly in real time at the point at which you're making your policy. So there's a lot of uncertainty around this, but I think I would put myself, closer to Megan in that I would put myself at the upper end of the sort of range that the bank has set out. Analytically, we've said it's somewhere between 2 to 4. I'd be surprised. I would think I'm more likely in the upper half of that. But very, very hard to know. And so it's one of those issues that we debate and discuss and put a lot of effort into.
I kind of wasn't expecting a number from each of you, to be honest, but it's just interesting here because of what you said, Professor Taylor, because for me, if you feel like because obviously the restriction has an impact on the economy too, right? As you know.
Yes.
And so if you feel like we're too restricted at this moment because we're too far away from where we need to end up being, you may feel like now is the time for more urgent action to get towards that place. And I don't know, Professor Taylor, if you could elaborate what you meant when you said that, and if you feel that because of the things that you've already described about how a lot of the inflation stuff that you think is driving it will dissipate over time, that now's the time to act faster. Could you elaborate on that?
Yeah, I think that was very much part of my thinking, that if I saw a greater weight of downside risks and that I felt, based on my estimate of neutral, that we were more restrictive than maybe my colleagues, then I felt we had more space for an extra cut this year. And I thought the extra cut was justified on insurance grounds when I saw that constellation of risks building. So yeah, I think that contributed to my feeling that we had quite a bit of space left to run.
Okay. Then the other thing that I've picked up in the discussion, you've all talked about sort of the supply side as well. Is that a signal to government to do particular things as well? Because the tools that you've got are obviously quite blunt. You have the interest rate, you've got QE and Q2 as well. That's the armoury you've got when it comes to monetary policy. Is there anything you would like to see, or are there any thing that you'd like the bank to have more control over, really? I'm trying to understand whether or not you feel like you've got the tools you need to do your monetary job. And I know it's going to be hard for you to answer.
Not in the market for more control. Look, I think, and by the way, these issues, as I said earlier, are not unique. I think it's really important. This is not unique to one government. These have been going on for some time. I mean, John Glenn and I have discussed these in the past many times. So I think, look, I'll come back to the points we've made before. Two things. On the productivity side, I mean, it is important because productivity in this country has been weak now for quite a long time. Investment is an important part of that story. So I think things that the government is doing, and by the way, the previous government was also doing, because there's no difference here on things like pensions reform, I think are important. Things we did on long-term investment in the past, which we were very involved in, are important because these are the things that can create the ability to improve investment in the economy. So that's one thing. The second thing on the ageing of the population, and again, look, the UK is, I mean, all developed countries are in the same place, so there's nothing unique about the UK in this respect at all. I just would say, I do think it's important to have these issues thoroughly on the table and to make sure that they're sort of well understood, not just in this building, but more generally, because I think the importance of this issue as a headwind, a structural headwind, it is critical. I mean, it is a very important issue in terms of not just in terms of both of the the labour force, and in terms of the cost of health and welfare.
And can I take from that you don't think it's central enough to public discussion at the moment? That this demographic problem we have in ageing society, you don't think it's central enough to our public discussion?
I think. Look, I'm going to stop it because I'm getting very near to the edge of my remit, as it were. All I will say is, and of course you're very keen to get me onto that. But look, I would say this: I do think it's important to explain the underlying issues. It's really important to explain the underlying issues here, and they affect us obviously, but they're not for us to take on the responsibility for.
Do any others want to add to that? No, I'll probably tempt you outside your remit, that's fine.
Thank you very much indeed. I'm going to now adjourn because we're expecting a vote, so order.